I do actually think that there is fundamental value to having our own form of money. Bitcoin started with a vision of money and sort of like eventually settled on something which is a bit more narrow of a digital store of value. ETH, the whole monetary policy was like changed so that it became more like money, and like the whole narrative formed towards ETH is money. And that's because people recognize that money is like the holy grail that you should actually be like aspiring to. As much as we tell people BTC or ETH is money, they don't treat it like money. 90% of volumes on sexes or on chain are all stables. So like digital dollars are actually money. That's actually what money is. And that's kind of what we view as like one of the largest opportunities within crypto is, can we create our own form of money?
One of the most interesting spots, I think, in crypto right now, where the two most talked about projects are a meme of our president, Joe Biden, and a stablecoin project. That's where we're at right now.
I honestly was not expecting it, to be honest, to grab this much interest. I think that there'd been other projects which had sort of done similar things in the past. So I'm not exactly sure what sort of triggered the interest this time, but yeah.
That's interesting. So you didn't expect this kind of, because you have not only a ton of supporters and people that think this is, one of the easiest big wins, going to be a giant force in the DeFi space, potentially give Tether a run for its money, but you've also attracted an insane amount of people that are saying this is catastrophic, the next Luna. Like, it's one of the most divisive projects. A stablecoin, you usually don't expect that.
Yeah, well, I think, it's definitely understandable after like what we saw last cycle that there is a bit of like a visceral reaction to something which might give you a flashback. And I think the yields are like really what sort of caught people's eyes. I think if we came out and like funding was at 11%, no one would really like blink an eyelid. And yeah, it was a slightly strange situation on our side. I remember chatting to the team where we were like, do we need to artificially actually drag down this yield and just like put the money in like a reserve fund to just stop it looking so crazy, like optically, which I think we tried to do in the first week to just try slow the growth down and do it in a responsible way, and got quite a bit of pushback on that, just in terms of the way that we communicated it. But yeah, I think obviously the backdrop with just where like funding rates have been surrounding like the ETF news and stuff like that has been like an incredible tailwind. So that obviously like catches people's eyes when they see those rates. I think the bit that I was just more surprised around was just the purpose, like the most like well-known instrument within crypto. It trades like literally trillions of dollars a year, and then it just seemed like 90% of people on CT just didn't know what a funding rate was, which was like quite mind-boggling to me. Yeah.
Oh man, well, I'm somehow not surprised. I am a little bit surprised, but I'm also not surprised by crypto. It attracts the brightest minds, it attracts the dumbest minds, and both groups actually make a lot of money here. So I see why like both can survive. I think that's why we have so many people like that are able to do that.
Yeah.
All right, so I want to get into why it's so exciting, why some people think it's the next Luna, even though I think that's a ridiculous comparison. It's a fun kind of thought experiment to go through, and it helps people just understand if they do still think that, or if they do still have concerns. I want to go through all those because I actually think there's some that people have highlighted on Twitter that you still find kind of interesting in terms of thinking about risks and where this all goes. But to kick things off, before we talk about that with Ethena, I want to ask you something I haven't seen anyone else ask you on a show. You now have this token launched. It's one of the largest and most hyped token launches in a long time. It's worth, I think, $18 billion yesterday, hundreds of thousands of users, 30% yield on the stable. And you made a decision when you launched to airdrop a couple niche NFT communities: Melodies, Schizo Posters, and Redacted Remilio Babies. For people listening, they can look up what those look, or I'll flash them on the screen. But why did you make that decision? Because it kind of was a genius move. You have this army of supporters now on crypto Twitter, the most engaged group of people in the entire crypto space, or this Melody audience. Why did you decide to go with them?
Yeah, I think you're getting to it. I think there's two reasons. Like the first one is a much softer reason. I just sort of like vibed with the communities. Like I've sort of been hanging out in their Discords for a while, and just sort of like, I don't know, just like the vibes of the people who are sort of associated with it. There's actually a bit of a backstory for my profile picture on Twitter. I approached Not So Fast, who used to own my profile picture, and none of the Schizo posters, like the rare versions, had actually been sold at all. So I was just trying to see if he would actually do a deal like direct. And he basically just said, here, you can have it, like complete, like literally zero strings attached or anything.
No way.
And I was just like, all right, I need a, like, and he was someone who'd been quite early to that community, and sort of like a bit of a champion for that collection. And so I just sort of like remembered that in my mind, and I was like, I was going to pay it back at some point, just to sort of like thank him for the generosity there. But yeah, I think maybe like just more like thinking about that as like a strategy. I'm quite a firm believer that actually valuations and the way things sort of trade within crypto are like 10% embedded in some form of like fundamental, and then like 90% just based on like narratives and attention. Like I do actually think that attention is basically the only scarce resource within crypto. And yeah, as you said, I think that those communities on Twitter are like pretty loud and grab people's attention. And so I think like associating what is supposed to be a reasonably serious project with what looks like quite ridiculous like NFT communities is just something that people are going to like talk about. And so yeah, we just wanted to sort of like grab that virality with it.
That's incredible. The not so fast relationship there. He was actually the second guest on this show. So shout out NSF for the inception of a couple cool things. But yeah, man, it was wild to see even people that didn't benefit from the airdrop. Like I saw a lot of, before you included the Melades, it was just schizo posters. It was the first time I'd ever seen kind of like that many people rally around an airdrop that didn't get the airdrop. Like instantly they were like, I don't even know what Ethena is, but we kind of owe it to them to figure it out. And it turned into this hilarious like viral moment of everyone supporting Ethena, even if they don't have the token. They're like, this is cool, this is based.
Yeah, I'm glad you like that.
I was helping a Memecoin project lately, and now I might even tell them like somehow figure out a way to airdrop to Retardio or one of those groups. It's just a genius move. Like they dominate things.
You picked up a picture yourself, right?
Exactly. Like you were the inspiration for that. It's always been my favorite collection. I just thought they looked cool. And same as you, like hanging out in their Discords and Friend Tech, I think 4 or 5 of the rooms that I would just hang out in all the time. Like obviously I was farming that. So you'd own some keys and I was, making these queries of what are the best keys to own, what's going to earn me the most points. But outside of that, there's a couple of accounts I found like Nyax and Bumps and Exology, like these just random Melody accounts I had never followed. And I was like, these are just the best rooms to hang out in. I tweeted the other day, I was like, I find a new Melody account on Twitter every single day to follow. I've never really had that thought with a Bored Ape. Like if I see their posts, I'm never like, let's see what they're posting about. If I see a good tweet from Melody, I click on the profile and I'm like, what else are they cooking? Usually it's good. Like usually it's good meme coins or it's good unhinged takes. Like they cover everything.
Yeah.
So yeah, God, I just love that move. Genius move. Anyways, trying to think how to, what should we talk about first? Like why people love you, why people hate you. I think both are pretty fun discussions. I think one way to break into things though, if they're not as familiar with Ethena, just a quick rundown so people understand before we get into those hypotheticals and some of those scenarios. Let's walk through the current stable coins. One of the ways you describe them are there's only 3 ways you can back a stable, right? And you kind of walk through USDT, things like algo stables, and then the other options. Like what are the 3 ways and how does Ethena work?
Yeah, I think the normal fiat stable coins that you'll be used to, like USDC and USDT, very basically you've got a T-bill or like reverse repo sitting within a bank or an SPV, and then you're just issuing a token against that. It's obviously extremely liquid, the collateral that's backing it, but obviously just has like a very different censorship profile to sort of using crypto assets. Then you've got, I think CDPs are probably the most important next category at a very basic level, and obviously MakerDAO is the most famous version here. You're putting up some form of collateral and then borrowing the stable into existence. We've seen like a few projects that look vaguely similar to Maker, but you can sort of think about where is the source of like the return coming from that. And generally that's like the demand for leverage on chain to just like borrow against your collateral. And then we obviously saw a shift from Maker, where during portions of the bear market, they held around 50% of like Maker's backing was actually sitting in RWAs, which is actually quite an interesting piece around Maker, which is it's actually really powerful that they have like the flexibility to be able to adjust in market cycles, like the composition of their balance sheet 3 times. So at the bottom of the bear market, it was like the best return ever was just sitting in SDI at 5%. It feels crazy to sort of say that now, like sitting where we are. And that was because they had the flexibility to basically like stop doing crypto loans at the same extent and like flip into RWAs. And then now as the bull market has actually expanded and you've seen rates on chain and obviously the basis within the futures market expand, they're obviously trying to use that flexibility now. And there's obviously pieces that they're touching with Ethena now to try and leverage the basis as well. So I actually think the design of Maker is like super interesting in the way, and it's a bit misunderstood in terms of their ability to like really just pick and choose when does it make sense to tap into these 3 sources of yield. And really those are like the only 3 sources of like actual real yield in crypto, which is like stake these returns, RWAs, and then the basis on the futures market, which has kind of been untouched until basically Ethena came into the market. And then the final sort of category you might want to put it in is us sitting there with like a delta neutral design. I don't think you've really seen anyone do it at the same scale that we've done at the moment. So there were two projects which did a similar thing back in 2021. So there was one on ETH called Lemma and another one called UXD on Solana. The TLDR why that didn't work was just, I think, timing and just their focus on doing it all on chain. Like the derivative market on chain is a 30th of the size of what you see in centralized exchanges. And like, you basically just need that capacity to be able to do this at any meaningful scale. So we took a very explicit trade-off to choose the scalability, liquidity, and like depth of market within centralized exchanges over like some of the benefits that you'd get from executing on chain. And that's just a decision which you're obviously making a trade-off, which we thought was worthwhile. And I know some users won't sort of be happy or accepting about that. But we thought that it was just a pragmatic sort of like solution in the middle.
Before we go through the scenarios of people like CL or Andre Cronje, like just the best Twitter takes of concerns that you think are valid, the collapse scenarios, the 100x upside scenarios. One other thing that I want to touch on just based on your response there is like, could we rip through the options of like what the trade-off is for each stablecoins? I think that'll also just cement things for people because like Tether also, you know, people have been saying Tether's going to collapse for as long as Tether has existed, and they're wrong every single year. There is no risk-free stable. So like what's good about each stable and what sucks about each one, I guess? If you could just run through like USDT, USDC, DAI, and then Ethena.
Yeah, sure. I think USDT and USDC are obviously just incredibly useful as like trading instruments because they're so liquid and they're embedded within centralized exchanges. So I think one thing that people sort of forget or like misunderstand why is it that they're actually able to like internalize so much of that yield to themselves. It's because they're so fundamentally useful on exchanges as trading instruments. And really that should always be like the North Star or the holy grail that stable should be trying to work towards, which is when you're actually used as money, it like unlocks a lot for you to be able to like capture returns yourself. So even if you, so like if you think about every single like spot order book pair on Binance against USDT, people don't care that there's not like a yield there. They're basically using it to actually trade. And that's just an enormous sort of like moat that they built around themselves, which I think is actually quite powerful. In terms of like the drawbacks, like that is obviously the drawback from a user perspective, is that you're essentially like an unsecured creditor to either Tether or Circle, and you do take custodial risk on the underlying assets. So we used to think that USDC was like risk-free, basically, like return-free risk. And then I guess at the beginning of 2023 with what we saw with SVB, we learned that there was actually very real credit risk that's at in terms of where the actual underlying assets were. And this is something that I've tried to encourage people to think about when they're really thinking about the risks of Ethena. So we should not be comparing like the risk of Ethena to USDC without considering the reward as well. So like think about this on risk-adjusted basis where you're getting paid 0% to be an unsecured creditor to Circle, and then every now and then you get wiped out for 10% of the face value of your assets, which like it's an okay trade. It's not like, doesn't sound like amazing to me. With Ethena, there are obviously financial and like operational risks around how it's actually constructed. But like a lot of these things, you can actually really box up the risk and understand like if this goes wrong, maybe you lose 1% or 2% or whatever it is on the principal balance. But if you've been earning 35% through the year and then you're left with 1.33, 30% less a point or two at the end, that's not actually like the worst outcome ever when you sort of contextualize the risk relative to the actual return. So I'm sure we can sort of like jump into this later, but it's something I just wanted to sort of like flag that when we always think about these risks, they just need to be contextualized like relative to what it's actually providing you. And then, yeah, I think the drawbacks with CDPs specifically is more just around like the idea of scalability and actually like the unit economics. So because you're putting down $2 of collateral to like borrow $1 of DAI into existence, it's just a naturally pretty unscalable model because there's only so much demand for people who are wanting to put down ETH and then borrow against that. So that's just one piece, which is like sort of like hampered the size that's something like a MakerDApp can actually grow to using a pure CDP design.
I saw that Arthur said that one way to kind of think about this is if you're betting on USDT or USDC, you're kind of betting on the banking system supporting crypto. And with something like Ethena, it's almost like centralized exchanges and like crypto exchanges supporting crypto. Like obviously there's a risk to both. If crypto exchanges all go away, it's like Ethena would suffer more. But if banks cut off Tether and USDC, obviously Ethena can still survive because it really just relies on crypto exchanges. That's kind of the consideration. Do you think that's a fair way to lay it out?
Yeah, absolutely. And I think we have sort of like maybe lost sight a little bit of like what we're actually doing here as an industry in terms of like just the acceptance that we have of like basically the most important financial instrument that we have within the space is completely centralized, sitting like within the US banking system. It's not something that you sort of like care about until like you really care about it. And so I think that there is actually like something that's fundamentally useful. If you put like aside all of the yield and all of the like financial engineering that sits around that, I do actually think that there is fundamental value to having our own form of money, which I actually think is sort of like the killer app of crypto. If we think about like Bitcoin or ETH, Bitcoin started with a vision of money and sort of like eventually settled on something which is a bit more narrow of like a digital store of value rather than like money itself. ETH, like the whole monetary policy was like changed so that it became more like money, and like the whole narrative formed towards ETH is money. And that's because people recognize that money is like the holy grail that you should actually be like aspiring to. And what we've actually seen is that as much as we tell people BTC or ETH is money, they don't treat it like money. Like 90% of volumes on sexes or on chain are all stables. So like digital dollars are actually money. That's actually what money is. And that's kind of what we view as like one of the largest opportunities within crypto is, can we create our own form of money? And I do think that that is like a fundamentally important thing to strive towards. Going
off that, let's talk about the doom scenarios. These are fun to think about. It's been entertaining on Twitter to see the Melades battle with the people that say this is the next Luna. And it's also, I think some of the concerns are valid. And I think even you said some of these are like the things you're trying to think through. But I'm just going to highlight some of my favorite ones that I've seen, or at least the most common. First one is a tweet from CL. And he said, Ethena futters are actually more redacted than Luna supporters. And I think it's a good shitpost. But also, I want to bring up how this is different, because it's the most common thing brought up. How is Ethena different than Luna, which we all saw cause one of the biggest catastrophes in the crypto market with their algo stablecoin, right? That's the one comparison we have here. Luna was an algo stablecoin ecosystem. Ethena is also somehow a synthetic dollar algo stablecoin. What's the key difference? Like, why is that a ridiculous comparison in your view?
Yeah, I don't know how people actually define algo stables themselves. Like, I have a pretty narrow definition, and it might be different to the way that other people view it. But in my mind, I was always around like the endogeneity of the collateral that's sitting behind it, i.e. UST was backed by Luna itself, and it's like the self-referential system, and like the backing is like the governance token itself. Here, obviously, the collateral is totally external to the system, like within Ethena. You've got ETH, BTC, and then hedges against it. So it's fully collateralized, while Luna was completely under-collateralized and basically was surviving on basically your faith in like market makers' ability to keep the peg, and as like a form of like a central bank. So really that's like the most important difference here, which is like Ethena's governance token has absolutely nothing to do with the backing of USDE, and it is fully collateralized by like real crypto assets with real liquidity and like a hedge that's in behind it.
So even though, because I know some people, and it's kind of as you said, most people don't even understand funding rates, so they still are going to hear that and say, well, Luna had some, Bitcoin backing, and this one has Bitcoin backing. The key difference here is that Luna under collateralized. This is fully collateralized, and it's also not just relying on market makers trying to keep a peg. It's collateralized and also delta neutral.
Yeah, that's exactly right. I think at the absolute peak of their BTC holdings, it was maybe 15 or 20% of the backing of UST was sitting in Bitcoin. So yeah, again, I think it's really the under collateralized versus collateralized piece here, which is the core difference to understand.
1 point for Melades, 0 points for the Luna futters. Let's move on here. We got a tweet from Andy. He said, and I also like this take. This is a good one. I'm curious to get your opinion. Probably the second most common concern I've seen. Andy tweeted out, he said, Ethena is only good during bull markets. And then he said, my brother in Christ, all of crypto is only good in bull markets. This is in relation to how much yield you guys are able to produce and why Ethena has been so interesting, has been so attractive, right? You can have this yield of 27 or 30%. Obviously that yield can change, right? You're able to capture it based on how much people want leverage and stuff like that. So in a bear market, you wouldn't expect to have so much yield. But like, what's your response to Ethena is only good during bull markets? How do you think about that?
Yeah, I think Ethena is going to be quite reflexive to the cycle, where it's going to look like the best thing ever on the way up. And then in a bear market, I think the design can still produce like above RWA returns in a bear market, which is like just based on the back testing that we've seen, which it really depends on like how you think about the hurdle rate here, where I think even during 2022, the core yield actually beat US Treasuries if you're sitting in something that looked like this. But ultimately, like obviously people are going to be stepping out as that sort of like unwinds from like a bull market to the bear market. I think my general approach to these things is like, I'm a very strong believer that these are like market set interest rates and market forces, and that it's really going to decide how large should the USDE be. And all USDE is responding to is like market set interest rates. And so when funding is at 60%, that is the market expressing to us that USDE needs to grow orders of magnitude higher than it is. And when funding is like super low and has like declined in a bear market, that's just saying that we need to shrink relative to the market. And so we lift the shorts, which allows like the funding to be in reverse. Having said all of that, you really only have three choices, as I said earlier, in terms of like where do you produce a yield on a stable-like asset. And I think what Ethena has built is not replicatable in terms of like someone else just deciding we're going to fork this and go do it ourselves. But what other people do is very easily, we're very like easily able to sort of like add that to what we're doing. So if we decide at the very bottom of a bear market, like funding is absolutely terrible, whatever it is, you just close the positions and go sit in an RWA for like 3 months, and you can kind of wait until the conditions do get fine. I think that's one thing that people forget, is that when you close down the positions, you're back into USDT, and then you can sort of like decide where do you want to sort of go from there. So my view on it is that like the infrastructure that we've built, and I guess the relationships with the centralized exchanges and stuff like that, another project can't come and do what we do, but we can very easily sort of like pivot into another source of yield at a different part of the cycle when it makes sense.
What's an interesting segue to that is, I hadn't thought about this before, but I'm realizing it now, is traders should actually love you in a sense. Like if the trade that you guys are putting on, like even if they're not in Ethena or using Ethena USD, during a bull market, you guys are kind of helping keep funding rates in check because you're capturing that yield. You're kind of bringing things back in line of if, you know, the cost of leverage is super high. Is that like, do you think that's going to play a material impact of like, you make it cheaper for people to long their longs and take it? Not that I'm not saying people should go out there and 100x their longs, but that's just what people do. People love to long their longs, own Bitcoin. They can buy 10 shitcoins on top of it. Like, it's kind of a funny thing where you're actually supporting people willing to gamble and take out leverage on their coins. Yeah,
there is like a bit of a flywheel here, right? Because we're just like really passive, like non-toxic additions of flow to the market on like just on the short side, obviously. And as we sort of like compress funding, as you say, that allows other people to step in and sort of grow things, which are like really allows like a really interesting flywheel to develop around the derivative markets and crypto in general. I mean, even like looking back to last week, ETH funding was like 70% for like over the weekend and like the days leading into the weekend. Imagine where that number would have been if we didn't have $2 billion of shorts on like 10 billion of ETH open interest. Like at the moment, we're like 20% of the open interest right now. So it is quite funny to see it, where like even at the size that we are at right now, the apes are just like too strong during this market, and like you really can't even like compress them. So, but I do think that like structurally, the whole point of Ethena is that we've identified you're getting paid too much for an unlevered cash and carry in CeFi, and that interest rate should never be 30, 40, 50, 60%. It should be 10, 12, 15 type. And yes, the yields are going to compress over time, but that's going to happen because we're doing our job properly, and that's actually like an outcome of like us identifying an inefficiency and making it efficient.
All right, so another tweet from Key Young. He said that Ethena Labs is not DeFi, it's CeFi with custody execution related risks. Do you think that's a fair take, in that you're not actually a true DeFi project? I mean, we kind of talked about the trade-offs earlier, but I know that could be a narrative people are going to spin up of like, this is just another CeFi thing. How do you interpret that?
Yeah, I do think that there is, it's a pretty valid criticism. I think we've tried to like find pragmatic middle grounds basically between like true CeFi and DeFi. I think the one example there was around the custodial setup, where we didn't want to take users' assets and just throw them in a black box on a centralized exchange. We wanted to use these off-exchange custodians where users' assets were actually being withheld from the exchange. So yes, you are putting a trust assumption into custodians to do their job. But again, we're just trying to find like pragmatic middle grounds between providing a product that's actually scalable and useful for people, and like the idealism of DeFi itself. So I think when you do peel back like the onion a little bit within DeFi, you start to realize that a lot of these things are not too dissimilar, but maybe just being like less open around where those trade-offs actually exist. I mean, if you just look at Maker, and by the way, I'm a huge Maker fan, we're going to be working with them, all those different types of things. They've got like $1 billion of RWA sitting in a hedge fund in New York. Like that's not that DeFi either. And I think we just got to like appreciate that there are like pragmatic middle grounds to a lot of these things.
Going off that, of a lot of these things aren't too dissimilar. Tweet from Chain Yoda. He said, crypto VCs are funding algo stables again. This is the end of the cycle. This is the last cycle. What's your take on why all the other options have failed? You talked about it earlier on how some of these things have tried it in previous cycles, but maybe they tried to use on-chain or decentralized exchanges, so they couldn't get as big. They couldn't have your scale. Is it a timing thing of like, we're just at a point in crypto now where you're able to do this because everything's bigger, or is it your design? Like no one has truly tried your design yet.
Yeah, I think no one's really attempted it in SocialFi. So this is like the first time that that's being done at like a true scale. I do think that actually we're quite fortunate with like the structural dynamics of this cycle versus last, which have actually opened up like an enormous opportunity for us. So all of the things like Celsius, BlockFi, and all of those centralized like sort of earn and lending platforms, you can really think about those as just like a conduit between retail's putting it in dollars, and then they're lending those dollars to a hedge fund to either go farm on chain or do like a delta neutral strat somewhere else. Those don't exist anymore. Like they blew up and they have not returned to the market in any way. So there's like tens of billions of dollars of cheap borrow that used to exist that no longer exists. And so if you're a crypto native fund now and ETF news is popping up on your screen every day, is it rational for you to go and capture like a 30% delta neutral? Or did you learn last cycle that actually when you're getting paid 30 or 40% to short, it actually made sense to be like completely long because actually the asset will go like 2 or 3x over the next few months. And so I think there's just like basically a complete dollar shortage within crypto now where you can't actually get access to cheap borrow to actually put this on. And so some of the largest balance sheets that would be doing that can no longer be doing that now. And then on the other side, you've obviously got like bullish sentiment, which is coming. And I think that's why you see such a dislocation and why it was such fortunate timing for us to come out now, which sort of like produce those dynamics.
These two, I think, those are kind of the easy ones. Those are the most common ones, but I wanted to run through them anyways, because as we've both just seen, most people don't take the time, right? They just look at this, say algo stable, monkey brain, Luna, similar. These two are, I think these you responded to, or at least in my mind, they're the most interesting to think about. One is from Andre Cronje, and you said, you know, these aren't mid-curve concerns at all. You rightly point out the risks that do exist here. What was Andre talking about? The risks that you actually do think are worth considering, or the ones that you kind of find the most interesting?
Yeah, I think the custodial piece, like while we do think it makes sense to have these assets within custodians, and that they're actually potentially the safest space to have your assets within, like crypto capital markets in general. That is obviously a huge risk here where if there's an operational failure with the custodian or some sort of hack, you will like lose a huge part of the backing. Thankfully, we haven't seen that at like any material scale with the custodians that we're working with in recent years. So that's like one piece that I think helps to calm some of the nerves over there. The other one around like the product design itself, people focus on the negative funding. It's not something I'm actually particularly nervous about. I think the market basically adjusts to that by itself. It's really around actually liquidity when you're at a large size, where you can sort of think about there is a cost of liquidity to get into the product and then out. So at a very basic level, when assets are coming into Ethena, we need to execute a hedge on the other side, which obviously has some form of like slippage and like embedded transaction cost. And then when people want out, you have to unwind that and sort of do that on the other side. The point here is that if everyone wants out at the same time, there's not infinite liquidity on perhaps to be able to do that. They are extremely deep, so like 8 to 10 times more deep than spot markets on most assets in perhaps. But what we basically need to manage is the fact that if everyone wants their money out at the same time, we're basically pushing on that cost to users to actually execute and close and get their assets back. And so where that might cost you like 10 basis points on a normal day, if everyone's wanting like $500 million out in like the next 5 hours, there might just be a cost of slippage. And so we can never internalize that. We can never like hide away from the fact that this like embedded liquidity cost does exist. We just have to push it onto users and give them the choice. Do you want to exit at like a 50 basis point haircut or a point haircut instead of like 10? And so that to me is actually the risk, which is there is going to be a period in the next few weeks where liquidity is thin. We can't sort of like get that much sort of size out in a short period of time. And the way that we're sort of thinking about managing this is just around like the duration of like the assets that are sitting on chain. So you might have noticed with like SUSDE, there's a 7-day lock to get out of it. And so when you're sitting in there, that's just to actually help us sort of like throttle some of these withdrawals and make sure that you're actually spreading it out through time. And we also have like a max withdrawal amount per block, which is a pretty large number. It's like $2 million per 10 seconds, which just helps us to sort of like manage some of those outflows as well. The point here is that it's not like this risk is not something that you wake up tomorrow and you've got like a 0 or like 90% down. It's like when you want to get out, you maybe lost like 1% instead of 10 basis points in bad conditions.
I mean, if Satoshi moves his coins and we have a black swan like that, I'm probably not going to be worried about like the 1% slippage. I'm probably just, my shit coins that I'm in are probably at 0 anyway. So like I'd be, being down 1% on slippage that day is probably a win. That's how I think about it. Going on to some of the benefits, why people are excited. This is a tweet from Suzu, and we can kind of talk about where this gets super interesting, why I'm pretty excited about it. But he was talking about the biggest upside and downside for Ethena is game theoretic. At first, exchanges benefit from Ethena TVL and their investors, and then later, Ethena at sufficient size can king make. Flows of capital away from one exchange towards another can cause bank runs. Ethena could begin to compete directly with exchanges by offering perps, and kind of saying that at a certain size, you guys are kingmakers, and this becomes super interesting. We've already seen now Maker is thinking about contributing to you guys, and you're able to kind of swallow up, like, you're doing this trade, so why wouldn't they try to capture some of that yield? Like, looking at some of these growth perspectives, how do you think about Suzu's take there on whether or not exchanges, like right now, obviously people love it, but like, do you guys become even a bigger force than them pretty soon? Like, how do you think about that?
Ultimately, it's... I don't think we'd ever sort of hold that much power because ultimately we're on that platform, right? So you can think about this like Tether versus like a custodian who's holding their assets for them, where if a bank is holding Tether's assets, even though Tether's making like 100x more like P&L than them like per employee, they ultimately can like shut it down and say like you can no longer hold your like underlying assets here. And so that's always where the power sits, which is like within the platform. And so fundamentally, we rely on these guys to actually hold the product as actually obviously being on their venues. You might see some of the competitive stuff that he was describing where like exchanges might sort of push to have us more or less involved like between themselves. And that's obviously something that we just need to manage through time. I don't think it ever gets to a point where like we're ever threatening a SEX with like flows that are occurring on Ethena versus them. But there is actually a second order piece to this, which is quite interesting, where you can think about actually a lot of the inventory that's sitting within Ethena as potentially like really interesting, just like liquidity to trade against like OTC. So we kind of know where we want to be buying a perp or selling a perp, and sort of the same with the spot inventory that's sitting over there. As we sort of get assets coming through, we know exactly where we need to hedge and at what price. And so there is like an element here where potentially we become one of the most deep pools of like OTC liquidity where we know we're like a seller at XYZ. And you can sort of have people trade into Athena's book to avoid us actually going into exchanges as well, if that makes sense. So that's less of us sort of like trying to steal SEX's businesses. It's more us just trying to optimize execution costs on our side and ultimately provide like a better yield for the users. So
in a future world, maybe I'm still thinking of this being too big, but like you could maybe see like Michael Saylor or the BlackRocks of the world. I guess maybe BlackRock probably has a contractual thing to go through Coinbase, but like some of the biggest buyers like that coming to you guys, if you have all this flow, like maybe it makes sense to do it through you guys. Like, is that a possibility?
Yeah, potentially. I mean, like I said, we're 20% of like ETH open interest right now. So like, if you add it all together, we're kind of the second biggest ETH perp contract holder now, like behind Binance, if that makes sense.
Yeah.
If you put us basically on that list, would be number 2 behind Binance on ETH contracts. So yeah, like in an end state, if you've done that with like BTC and Sol at like 30%, it would be a pretty interesting like pool of liquidity for people.
I've seen some hypotheticals from the Gigabulls now that we've covered the critics, the FUD. Can Ethena truly dethrone USDT? And is that your goal? Like, as you look at this, is that a possibility, or does USDT, I guess there's always a risk. So like USDT could be shut down tomorrow. Like we can't really model some of these things out, but like, is there a world where, is that what you're aiming for? I guess is probably a better question. The
honest answer is no. There's obviously just fundamental like scaling capacity sort of constraints around what we're doing, where we can't ever be $100 billion in size at the current market caps. The only way we'd flip Tether is if, as you said, something gets shut down there and they come down rather than us coming up. Doesn't mean we can't get like pretty big. I do think we actually can get quite a bit bigger than people expect. But the vision isn't to sort of flip them. And I think we play actually kind of different roles within the system. I think is trying to find like an interesting niche of like not fully decentralized, not fully centralized, and then offering an interesting return for holding the asset as well. And I think fundamentally our view is that a lot of people in crypto basically just driven by economic incentives. And if you can put the right incentives around things, whether it's like incentivizing exchanges to actually distribute it for you. So every success story of a stable has always come with like a stablecoin pairing up with an exchange to actually distribute the product. We've obviously got like all 5 of them supporting us and I hope sort of like keen to see us grow. And they're incentivized by it because they can sort of like earn a lot more out of us than they can with Tether. And so, yeah, I sort of just see us fitting in this like interesting niche of sharing more of the economics with people to be really incentivized to push it. And like, I never expect anyone to be selling, to be holding a full, their full portfolio in USDT or their full portfolio in I always think that there's some balance that sort of makes sense between the two, and that includes myself as well.
We talked about how the synthetic dollar part of this works, and you guys being a form of money in that sense. We haven't talked about how the ENA token works. ENA, it's already at about a $15 billion valuation. It's a top 100 coin. It's week 1. Obviously, we've kind of walked through how this entire ecosystem grows, but like, what role does ENA play in all this?
Yeah, I think a lot of the discussions that we've been having around what's the composition of the backing behind USD, for example? Should you have like a ton of liquid staking tokens for more yield or less for like more liquidity and a safer product? What's your composition between ETH, BTC? Should you even have BTC? Those are like pretty important questions around how you actually design the safety and sort of like risk profile of the actual product. The other one is thinking about this insurance fund. So we have been collecting around like $5 to $7 million of interest income per week into this fund in the last few weeks when funding has been this crazy, which is a slightly insane number. It's like annualized like $300 million of like net cash flow into Ethena Labs. And basically what we're doing with that fund is trying to like add an additional layer of safety behind the product. But ultimately there's a decision to make around A, how big should that thing actually get? And should that cash be used for something else at another point in time? And then B, how are you actually managing that insurance fund, and what is it actually used for? So is it just like funding, or if you know, for example, the backing behind USD is 100 cents on the dollar, if it's trading at 98 cents on the dollar, can this actually bid and sort of like socialize some of the profits as well? There's like really interesting things that you can do around using this like second layer of safety within the system. And so really the governance token is going to be just playing a pivotal role in sort of designing a lot of these pieces.
God, I'm just excited that this is the first project, as I said, it's like the first thing that has people thinking about what's actually being built here. Like new, not that I'm not excited about Memecoins, it's been fun, but I think that people will hit a fatigue there. And to have a new entrant come in, and also some of these second order effects you talked about, where it's like, you're actually helping the apes, even if they don't use you. Now we have more cheap borrow. You can continue to 100x long your longs. It's like some of that stuff it's just fun to think about where this all goes, man.
Yeah. Well, I think on that point as well, it's definitely on our mind that we actually need to try to do it in a slow way, because as you said, there are multiple like second and third order implications here. Even what we saw with like DAI moving like the DSR the other week in a pretty like dramatic way, that wasn't even something that was like in my mind around like a big change that could be happening. And so I think when you are trying to do something that's net new and obviously growing at like a reasonable pace, it's not good enough for us to sort of just say like throw it out in the wild and see how it goes. Like we ultimately need to take some responsibility of doing that in like in a controlled and like thoughtful way. So it is super interesting to think about it, but I'm sure we don't know all of like the different areas that this is going to sort of impact further down the line. And that's why we sort of just need to stay on top of things as we go.
Beautiful. I love it. Well, hopefully this podcast, this conversation helps at least the people on the two sides of the curve, both in terms of IQ, but also just in terms of they love you, they hate you. Hopefully this might even spark some new discussions, but I think this will give them a more complete picture. Guy, I appreciate you coming on, man. I love what you guys are doing. I love that you've created this Melody army. I hope more projects follow in your footsteps of empowering that group and airdropping those people. It's a cool case study. You have an army of people that love you, and also I think this benefits the crypto market more broadly. So I appreciate you coming on and talk about this.
Yeah, I appreciate it, man.